Elon and Cathie Wood got into this on Twitter, and we all know the arguments for passive versus active. And there's large active funds out there that are just programmatically buying. And Elon and many think that active would be better for society, or a bit more active. Friedberg, what's your take?
A business is over time, it's supposed to be a machine that takes money in and puts money out. And then there's money left in the machine. It's like a box. Money comes in, money goes out. And over time, the objective, the money coming in, which is sales or revenue, exceeds the money going out, and the box grows, right? The assets grow. And the best way to look at that is in the financial statements of that business, the income statement, the balance sheet, the cash flow statement. But and then there's this narrative that can be layered on top of those metrics, that measurement of how well that business is performing over time. And that narrative is what drives a lot of investment decisions today, right? I see whether it's an analyst writing an analyst report, or a portfolio manager, or an individual picking a stock. Everyone's got a reason why they're buying the stock. And they say, here's my thesis. And what happens is everyone looks at that box, looks at that business, looks at that thesis from a different angle. And there's always something you're missing. So there's some element that is driven by imperfect information. And in some cases, it's just heavy bias. You look at a stock, you're like, hey, I really like Disney Plus. I really like the subscriber growth. But the question fundamentally is, over time, what is the revenue generation and the profit generation potential of that one thing you're looking at? And what are the 100 other things that are going to contribute to that business, that box, taking in more money or spending more money? Is that box going to run into a regulatory problem? Is it going to run into a customer problem? Is it going to run into a content problem? Is it going to run into competition? The number of issues and opportunities that any one of these businesses can and will face is infinite. And every participant in a market is looking at some different set of those opportunities or threats. And every participant in that market is making a different value judgment. And so very often people will buy a stock because they see their sliver. They convince themselves that based on the sliver of the perspective that they have, that this is something I want to own. They don't do the work on what's the income statement, balance sheet, cash flow going to tell me over time about the quality of that business. And they don't do the work on what the valuation of the business is relative to comparables, relative to future earning potential. And I just wanted to have this diatribe because I see so many individuals doing stock picking. And over time, because of this myriad of things that could go wrong and will go wrong, or may go right or won't go right, or the regulatory thing or the market thing or whatever interest rate thing hits that stock and the stock price goes down, eventually everyone gets hit on the head and everyone reverts to mean or below mean, meaning the average of the index over time, or underperforms that index over time. And so, for me, I spent 2 years, I know we all went through some sort of investment banking training. I spent 2 years out of college I had no finance, econ, or business background. I worked in investment banking, learned how to read an income statement, balance sheet, cash flow, learned to understand how business performance ultimately translates into financial outcomes, and spent a lot of time on valuation and figuring out, just because you like the story of a stock, you like the story that the CEO is telling you, doesn't necessarily mean that you're paying a fair price. So if everything they do goes right, this price could still drop. And I think that this is a really important set of lessons for people that are individuals that are doing stock picking, which is to number one,
so
make sure you know how
this message and this diatribe is specifically targeted towards day traders, retail, correct?
I don't know if it's just them. I think it's just generally make sure you understand how to read an income statement, balance sheet, and cash flow statement. Number two, make sure you know how to assess valuation. Make sure you know that when you're buying a stock, you know what the total value of the company is based on the price you're paying. And how do you justify that total value makes sense relative to your model of the future outcomes for that business? And then number three, recognize and be cognizant of the fact that whatever one thing you're seeing that you think you've got some edge or some advantage on because no one else is seeing it, there's 99 other things that you're not seeing. And this is where everyone learns this lesson over time, and everyone gets bonked on the head at some point in making these decisions. And it's why every stock picker, or nearly every, and we can talk about the greats at some point here and where alpha can be generated and so on, but generally most stock pickers over time underperform the index. And it's just, particularly with the retail movement of the last couple of years, I see a lot of thesis. Here's my reason for buying the stock that excludes understanding the financials, understanding the valuation metrics, and also excludes the whole litany of things and all the diligence that goes into thinking about all the other angles you might be missing. So
Chamath,
that was my
rebuttal or feedback generally.
It turns out that it's hard to be good at anything. Insert the blank takes tens of thousands of years of practice. In investing, I think what I have learned is that it's very easy to get caught up in the mania. I've also learned in the last decade that, we really benefited from zero interest rates. It was a tide that lifted all boats. And I have learned how to think about correlation and the difference between alpha and beta, and how to construct portfolios that I think can be all-weather portfolios. To Friedberg's point, those are nuanced, long-tail skills that you'll only take up if you're really passionate about the craft. It's not dissimilar to a person, I'm just going to use golf as an example, who learns how to hit a fade versus a draw, and who learns how to really manipulate, their wedges in very specific ways. And these are all long-tail skills that come in when you decide you want to master something. And it's just important to note that mastery is required to be really good. Because otherwise, there'll be times where you'll go out on the golf course and you'll crush it. But then, there'll be other times, and most other times, where you can go and get run over because it's hard. So that's my only comment, is that this is like everything else. It's not nearly as easy as it looks like.
Brad, you pick stocks for a living. How involved should retail investors be? Should they just buy an index?
By the way, Jake, I don't think it's fair to say retail. I think my point was really about...
No, his point is everybody.
Okay, sure, everybody.
My point is saying a thesis and excluding all these other factors that are critical in making a decision about what you're buying and whether you're paying the right price means that you have to make sure that you're expanding your point of view on whether or not a stock is worth buying at the market price today. And I think having that broader perspective is what I see missing in 99% of the chatter on Twitter, 99% of folks talking about what thing to buy and why they're buying it. And I think it's so critically important.
You're saying that most investing that you see is very narrative driven, and that narrative can sometimes be so powerful that it overpowers all the other elements that one should be doing to get a full picture of why you should be buying something. Is that?
I think that's a fair summary, Chamath. Yeah. And I think it's, it's just about how so much of what goes on CNBC, on a lot of Reddit boards, not all of them. There's some very sophisticated folks there doing very sophisticated financial analysis and looking at all the angles of a stock, assessing the valuation. But so much of these conversations exclude what you're paying and what you're getting, and exclude the broader context of all the things that could and may not happen with a particular business. And as a result, at some point, one of those things bonks you on the head, you lose 50%, and you're like, oh my gosh, my whole portfolio blew up.
And sometimes if you try to inject that logic into those channels, you'll get brigadooned.
You'll be absolutely brigadooned. Brad, what do you think in terms of people's access to markets, I guess, would be another way to look at this, and people's propensity to just, gamble, let's call it, or maybe not make thoughtful decisions?
I kind of think if our friend Bill Gurley was here, he'd be like, this is a 5-minute conversation about the statement of the fucking obvious. This is stock picking's hard. Really? Is that the theme of this section? Yeah, stock picking's hard. Very little alpha has ever been generated in a sustainable way, even by the greatest people of all time. I think, maybe something that is a little bit useful to add: 2 things. Not all good companies are good investments. Price of entry matters. Okay, so I hear a lot of people saying, well, I'm going to buy that because it's a good company. I don't even know what that means.
Exactly right. That's a big part of my point.
Good relative to the price of entry. But the second thing is the single greatest power we have as investors, the greatest single source of alpha, right? Other than stock selection, so choosing the right company, time arbitrage. Okay, so do you have the ability to own something that is a growing asset over a long period of time? So that if you got number 1 wrong, you bought it at the wrong time, shit happened in the world, they miss a quarter, etc., that you're not forced to lock in those losses because you over allocated to that. So this idea around portfolio management as a principal component of overall stock picking is just absolutely critical. So I think, I don't really, I love the fact I put myself through college. I put myself through law school, through business school, day trading stocks out of the back of the classroom. I'm grateful I live in a country that let me feel like I had some alpha and that I could do that. And I could go read the newspaper and sort it out. And I wasn't building sophisticated financial models. So I think there are ways that folks can do this. There are a lot more ways to lose money than there are to make money in a sustainable and durable way. Right. And so as investor, what we try to do, we've got 90% of our portfolio in our top 5 or 10 companies. Okay. I'm not an index. And the deal I have with our LPs is I'm very transparent with them. They know that we're going to own companies in size. And it's that portfolio concentration and our time arbitrage, holding companies for 3 years or longer, that is a strategy they choose to believe in and sign up to. But I know a lot of greats who would never subscribe to that strategy. So know your strategy, execute it, allocate a reasonable amount of capital. So when all of these unknowns that Friedberg talks about come along, you can react accordingly. And the final thing is, if it's not fun for you, right? Like if you're actually not passionate and curious about studying this stuff and learning about it, not everybody is, then don't do it. Right? Then don't do it. Then just put your money in index.
You're not going to be good at it if you don't love it.
Who is.
The analytical depth and rigor that the greats employ to be successful at picking stocks, at picking businesses and investing in them and selling them at the right time over time, does not make for good TikTok content. It does not make for good short form content. And I think that's why we've seen this dumbing down and this kind of short form thesis driven narrative approach to content creation around markets and stocks that ends up causing a lot of people a lot of harm. You watch the Jim Cramers of the world. I don't mean to disparage any one individual, but that sort of content that's like, this is a great company, we should buy it, let's go. And the depth and rigor takes a lot of time and a lot of effort to really do right. And then you get hit in the head.
When we
and that's what I've observed lately in a really kind of flurried way, particularly across social media and so on. That's why I just wanted to talk about this topic today.
Just to build on top of what you're saying, Warren Buffett made this very famous bet in 2000. It was him versus a bunch of hedge fund managers, and they were able to pick a basket of hedge funds. And he said, I'm not even going to pick myself. I'm going to pick the S&P 500 and the low-cost ETF, the Vanguard ETF. And he said, we'll check in 20 years later. Anyways, the punchline of the story. Buffett won. He won $1 million that he donated to charity, and these hedge fund folks lost. And so to build on your point, Jason, time and time again, the smartest investors in the world, i.e. guys like him, have shown us that the most predictable way to make money, if that is your goal, is to own the S&P 500, which is, a dynamic index of the 500 best companies in the world. So there are these people doing all the hard work for you, and they have very strict criteria of who's an S&P 500 company or not. Now, yes, if you cherry pick other companies that are not, or you concentrate in some, will you generate better returns? Absolutely. But systematically over time, that thing has lurched forward at 8% a year, 9% a year. If you invest dividends, you can approach 10% a year. And so if you really want to just grow your wealth, that's a very simple, steady Eddie way to do it. And to take a small amount and then go and, experiment with it to learn makes sense. But I think it's important to make sure you're going there eyes wide open to try to actually learn.
Buffett, of course, says the index works really well, but then he's got 50% of his public portfolio in Apple over the last few years. So he clearly believes in alpha as well. But, back to Friedberg's point, since we brought up Buffett, somebody asked Munger, why can't people just copy what Buffett does? And he said, because nobody likes to get rich slow. Nobody likes to get rich slow. If you want to, what did a 0% rate environment remind us all over the course of the last few years? Everybody had a grift. Everybody had a get rich quick scheme. I don't care whether it was NFTs, crypto flipping, or whether it was house flipping, or whatever it was. Everybody thought, this was easy. And frankly, looked at guys like us oftentimes and said, you're the dumb ones. You're playing the game that's really hard. Why don't you just, flip some crypto? And I think we're back to a world that if you really want to,
by the way,
yourself.
How dumb did you feel? I felt so stupid. All these tokens, minting, billionaire. And I just sat on the sideline. To your point, Brett, it made me feel so stupid.
I felt stupid. I was just like, who's the customer and how much do you charge them? And when you can't get that basic answer of who the customer is and how much it costs for them to buy the product or service, was like,
Brad's point, I think the punchline is, and then, at the 11th hour, it's like there's a tendency to just capitulate and say, okay, forget it, I'm in. And that's when all the money gets torched.